Hello and welcome to today's tutorial on the basics of the calculation method used by RentalCal to determine the profitability of energetic retrofitting activities. The financial technique behind it is known as the visualization of financial implications. When referring to this later on, we will simply call it FOFI. My name is Joseph Alexander. I'm a second-year PhD student at the University of Regensburg. The University of Regensburg team, under the leadership of Sven Bienert, was jointly responsible with the EVO Institute and the Karlsruhe Institute of Technology for developing the calculation tool. What can you expect from this tutorial? First of all, we are going to talk a little about the standard investment appraisal techniques and the characteristics of the FOFI that make this method most suitable. Secondly, we explain different levels of consideration, from asset level to investor level. This leads us to the analysis of typical types of payments that are included in an energetic retrofitting process and how the FOFI method can deal with those. Afterwards, we will introduce a small sample case that should give you some idea of which information is really relevant to the calculation, and on that basis we will discuss the calculation results. Before showing the underlying calculation technique in more detail in bullet points 6 till 8. Finally, we introduce the RentalCal web-based calculation tool. Quickly, before we start with the tutorial, I just want to make you aware of a so-called 5-pager that also deals with the topics covered in this video. For those who are more interested in getting to know the underlying calculations, it provides you with interesting insights and additional literature. At this point, you can open the document by clicking on the respective button on the left, or continue. If you want to download the document later on, open the European Perspective tab on the official RentalCal website and click on Summaries of RentalCal Reports. The last document displayed is called Financial Viability of Energetic Retrofitting, a Complete Financial Plan, FOFI. So, let's go. Investment appraisal techniques have developed a lot over the last decades. Nowadays, we distinguish between static and dynamic approaches. As energy-efficient modernization procedures have a complex flow of incoming and outgoing payments, static methods for assessing the benefits are rather inappropriate, because the timing of payments is not accounted for. It is a so-called single-period assessment. The dynamic investment calculation, on the other hand, resolutely addresses the timing of payments. This consideration is vital, since considerable costs are incurred, especially at the beginning of an energetic efficient refurbishment, whereas savings or additional revenues only accrue in later periods. Furthermore, in the case of modernization procedures, a long economic life or a long period of observation is assumed, and thus a refurbishment that takes into account interest and compound interest effects is essential for realistic mapping. Therefore, not only the general technical literature, but also the RentalCal Consortium agrees that the FOFI method must be applied in practice. Investment techniques are often used to assess the profitability of the property itself. Hence, only property-specific cash flows are observed. However, as energy efficiency investments are highly influenced by other aspects, the underlying calculation technique also considers the individual circumstances of the investor, respectively owner of the property. Hence, The decisive factor in using the FOFI method for assessing the profitability of energy-efficient modernization procedures is that this dynamic process involves not only the payment series of an investment property, but also the payments due to financial dispositions related to the property. This distinction, respectively consideration of these two types of payment, is central to energy efficiency projects, as cash flows such as financing or funding, depreciation, and the income tax situation directly affect profitability. How the derivative payments influence the original payments can be seen later in this video. We have set up a test case to show you the most important data for the calculation process. The list is not concluding. However, there is a non-professional private landlord who owns this beautiful terraced house on the left-hand side. The type of investor is especially relevant for the taxation and the investment period, 25 years in our case. At this point, I would like to mention that the chosen investment period is one of the most important input factors in the calculation, because too short periods can make the energy efficiency project unprofitable. This is due to the fact that energy efficiency refurbishments are still seen as a long-time investment that does not pay back within the first years of investment. Next, the amount spent for retrofitting reasons. We have around 260,000 euros of investment costs in total. Nevertheless, watch out! We are only interested in the share of investment costs that is related to the energetic refurbishment. For this reason, a division of total investment costs into energy-related and so-called anyway costs is necessary. You do not know what anyway costs should be? I give you an example. Anyway costs are those costs that would have appeared anyway within a normal renovation. For example, the setting up of scaffoldings. Those payments are therefore not relevant for making the decision on energy-related measures. The tool helps the user to differentiate between those two types of payment. In our case, 60% of investment costs can be attributed to energy-related costs. Therefore, only this share of costs that according to the principle of causation can be directly allocated to the energy investment must be taken into account. The next section, energy data, is either important for the owner or tenant, or even for both, depending on the rental contract and who is paying for energy consumption. This varies widely between European countries. The energy consumption determines the amount paid for it. Nevertheless, it also gives the possibility for the tool to assess also non-financial implications of the refurbishment. In our case, the savings amount for around 6,000 euros per year. This can either increase the profitability of the investment or reduce the additional burden for the tenant. It would lead way too far for this introductory video to explain the mechanisms of financing, but you will agree that the financing of the project has a major impact on the profitability. For most projects, it makes sense to use as much debt as possible to generate a higher return on equity. In this sample case, 60% of the entire investment costs are from a third party, for example your local bank. For a fixed interest period of 25 years, a 2% loan seems quite good in the current market phase. The tool additionally accounts for the type of repayment, for example bullet loan or annuity method. Last but not least, the setting of your property in the market. It is assumed that due to the refurbishment, rents can be increased accordingly. The tool considers different types and procedures of rent increases. In this case, it is assumed that rents will go up by around €2 per square meter and month. Additionally, the long-term vacancy rate of the property can be chosen. Now, as we know several key input parameters, we can go one step further. The FOFI structure can be illustrated as follows. In a first step, the income stream is determined. The net rental income is calculated for the periods of observation. The expected growth rate for rents is thereby taken into account. This gives us the cash flow for each period. Simultaneously, the refurbishment costs need to be stated and how those costs can be financed. Hence, how much of your money is necessary to realize the refurbishment project. The refurbishment costs are used to set up a depreciation plan. Several depreciation methods can be applied. Why is this relevant, respectively cash effective? Because the depreciation has an impact on the cash flow which you need to pay taxes on. Therefore, high depreciations during the calculation period can boost your financial result. But also the financial structure of your investment influences your tax scheme. The interest you are paying on your loan is decreasing the tax base amount. The tax calculation is then integrated into the FOFI. For using our FOFI method, it is assumed or required that the fiscal balance equals 0 at the end of the calculation period. Finally, the results can be displayed. The first two KPIs, which stands for Key Performance Indicators, are easy to calculate and to interpret, self-explaining. It gets more difficult for the calculation of the return on equity. You can see the formula on the right-hand side, showing the nth root of the ratio of final equity value as the numerator and the equity share of your investment as the denominator, with the big N standing for the calculation period N. The only difference in calculating the FOFI return on equity, including the green value, is that the numerator also accounts for the additional sales price. In general, the return on equity shows the interest rate you get on your invested money. This leads us to a different KPI, the so-called payback period. It shows us how many years it takes the investor to fully get his equity portion paid back. So, in our case, it takes around 16 years until the initial paid equity share is repaid. A value higher than the calculation period suggests that this will not happen within the given time, and therefore the investment is in that sense not profitable. The amortization period is easily calculated as the inverse of the return on equity. Finally, a very important figure for banks is displayed: the debt service cover ratio, short DSCR. It indicates us to what extent the additional income generated after the retrofit numerator helps paying the amortization and interest rates to the debt provider denominator. Any value above 1 is generally desirable, as it indicates that the modernization provides more additional income to the investor than he has to pay the bank for the debt service agreed on. In our case, a good DSCR is achieved because the debt service is covered more than 2.5 times by the additional income. Those key results are well suited for bank talks. They can be downloaded as a PDF file after finishing the input section of the tool. Now, after watching this introduction tutorial, there is nothing more to say than use the tool for your best to support your decision. You will be directly forwarded to the tool by clicking the respective button on the screen. If you have any questions regarding this video or anything else related to RentalCal or energetic refurbishments in general, do not hesitate asking my fellow colleagues or me. I will forward the request to the person best suited. Thank you very much for your attention and stay tuned.